Invest Africa, proudly brought to you by KPMG.
Welcome back to Invest Africa. Remember, we do value your suggestions and feedback, so please send us an email to investafrica@abn360.com or interact with us on Twitter through @CNBC Africa. That's hashtag Invest Africa. Still with me, I have my guest, Warren van der Merwe. He is CFO at Vantage Risk Capital. Ron the Besten right next to me, Managing Director at the Abraaj Group. And in our Nairobi studios, we have Michael Turner, the Managing Director for Actis East Africa. Again, gentlemen, welcome back. Michael, I perhaps want to bring you in on a point that Warren made just before we went to break, and this was on currency risk. How significant a consideration is this for fund managers when they consider where to plow private private equity?
It's a significant risk and one that is given a lot of attention as one enters the investment. It's obviously a risk because many of the investors that we manage capital for measure their returns in US dollars, so they're looking to receive a hard currency return. We are at Actis perfectly prepared to make local currency investments and indeed take local currency risk, but we assess that alongside the business risk, the underlying economic risk and political risk that goes alongside each individual investment. So we do look at currency risk. We have a natural preference to invest in businesses that are sort of underwritten by dollar-denominated returns, but we do not preclude local currency investments either once we've done that risk assessment.
Michael's given us quite a broad range of risks that are considered before those decisions are made. And perhaps what you may comment on, Ron, is having worked in multiple countries in private equity, the judicial and regulatory frameworks, are these enabling?
That's a good question. It's becoming more and more enabling, Nozipho, and we have some very interesting stats that's happening and playing out as we get the information. And you can see that countries that have embraced good governance and have accelerated the ease of doing business, their GDP has grown 3 times that of those that haven't embraced those. We see public debt coming down 52% to 35% from 2002 to 2012. Inflation dropping from 14% to 6%. Right. And public debt as a percentage of GDP being down from 4% to 1%. So in those countries where the governments actually embrace the enablers, they stand to benefit much more from the inflow of capital which is looking to come to their countries.
One of the points that I want to almost throw the gauntlet at you, Warren, that Ron has raised is almost how do you balance the policy considerations as well as the investment returns, and particularly if you look at Vantage and the fact that this is one of the leading black-owned private equity firms that has made quite significant grounds in terms of advancing the black economic empowerment agenda in South Africa. Now, how do you balance that, and especially if you look at other countries as well with what investors are expecting to come out?
Well, I think when you go into Africa, you overlay a whole list of extra risks that you need to consider, regulatory issues. Some countries have exchange control, some have usury laws. We're a mezzanine debt provider, and some countries you can't lend out money at more than 9%. So you have things like that. The tax treatments are complex across borders. So really, when you're investing in Africa, there's an additional set of risks, there's an additional set of regulations to understand, and therefore you actually need to be compensated for that in terms of return. You touched on black economic empowerment. I think that is an opportunity in Africa as well, because in a lot of these countries, local ownership is becoming an important feature, and that's where we can play a role as well, as using our mezzanine debt to fund those local citizens to buy into these ventures and companies. But yes, it is very complicated. We face regulations here in South Africa. We have some unfavorable tax changes that have been made recently. Going in across border into Africa, there are a whole set of new factors to consider.
I want to jump the gun perhaps a little bit and come back to you, Michael, and I want you to give us some insight about the importance of a very clear exit strategy for investors as they look at Africa. Is this a significant consideration?
Of course it is, and even before you make the investment, you need to have understood exactly how you think you're going to achieve your exit. The experience that I've had in East Africa is that exits are eminently achievable, and often the route of the trade sale exit is the route that is pursued. But we have exited investments through listings on the local stock exchange, sale back to our partners within the business, or indeed selling on in the secondary buyout market to other private equity fund management groups.
There's also a very uncomfortable question that often asked, but we hardly ever get the answer to that. And Ron, I'm hoping that you're going to be brave enough to take it on today. Where should fund managers not be looking to directing private equity in Africa?
It's an excellent question, because my answer to that would be you should go where nobody else wants to go, and make sure that you can get the right structures around that. I think the correct answer to that is that private equity is a risk business. It evaluates risk and it structures accordingly and finds the way to mitigate that risk, whether it's country A or country B. So Africa per se is a conglomeration of countries. One should guard against going country specific. You should look at the Abraaj model is to look at companies that can go regional. So a Kenyan company that can expand in Uganda, Tanzania, or a Ghanaian company that can cross into Nigeria, or a South African company that can go into Angola, Zambia, so that you don't just have one country focus, because that negates the one country risk, and that's what you want to do. So experience and being on the ground and having had time over 20 years of investing in these different African regions, it's all about structuring the deal correctly, mitigating for cash flows quickly up front so that you're not exposed for big capital amounts towards the end of the transaction, and then clearly taking a business model and rather take a management team that have delivered in a bigger country and let them start a branch or a subsidiary in a more difficult country and allow that to grow until the growth comes through and it stands on its own legs.
The final comment is going to come from Warren. This is our last minute, and I see you nodding, so I'm sure you have something else to say, but can you also address the increasing dominance of African pension funds in the private equity space, and do you think that this is a trend that is likely to be sustained?
We've certainly seen it. We've seen a lot of South African pension funds that have invested in our current fund and in other funds. African pension funds as well. We have a Botswanan pension fund in our fund. Yes, I think these pension funds, with changes like Regulation 28, which recently increased their allocation to private equity to 10%, have seen private equity come on to the pension fund radar. And so we see this as an increasing trend, a lot more interest in private equity from African pension funds. The nice thing about African pension funds is that they're already in Africa. So one doesn't have to, there's so much education that goes on with investors outside of Africa who are nervous about Africa and what's the political risk like and which countries. So yes, I think a big support of our industry are African pension funds.
I've got the go-ahead to close this conversation in Nairobi. So back to you, Michael, before we close. One of the key points that would always be latched onto the pension fund conversation is the developmental agenda that often comes with this. Have you seen the same approach in East Africa?
Not as explicitly as you suggest. The development agenda, of course, is important. At the end of the day, fund managers manage their return, their performance in terms of returns. And if you're a responsible investor and you're generating good, healthy, positive returns for your investors, the development agenda will follow.